Climate risk and valuation. Introduction: Understanding climate risk. Climate risk and its growing importance in financial decision-making. Climate change has moved from being a peripheral concern to a central issue in the global economic and financial landscape. The increasing awareness of its wide-ranging impacts has made it clear that the effects of climate change are not limited to environmental shifts. They directly influence the financial markets, business strategies, and investment decisions. As climate-related events such as severe storms, floods, and droughts become more frequent and intense, financial institutions, companies, and governments must adapt their strategies to address these risks. This course aims to explore the ways in which climate risk, both physical and transition risk, can influence the valuation of assets, the financial stability of businesses, and investment strategies. Understanding climate risk is essential for accurate valuation in an era where the traditional metrics used to assess value no longer account for the long-term consequences of climate change. We will examine various methods and tools to assess and integrate climate risks into financial modeling, offering insights into how investors, corporate managers, and policymakers can navigate the complex intersection of environmental change and financial stability. As we will see, addressing climate risk is not just about mitigating losses, it is also about seizing opportunities that emerge in the transition to a low-carbon economy. Part 1: The Science Behind Climate Change. In order to understand climate risk, it's crucial to first understand the science behind climate change. Climate change refers to long-term shifts in temperature, precipitation patterns, and other atmospheric conditions. This phenomenon is largely driven by the accumulation of greenhouse gases, GHGs, in the atmosphere, particularly carbon dioxide, CO2, methane, CH4, and nitrous oxide, N2O. Key drivers of climate change. Greenhouse gas emissions. The burning of fossil fuels such as coal, oil, and natural gas has been the primary source of carbon emissions. These gases trap heat in the atmosphere, resulting in a warming effect commonly referred to as the greenhouse effect. Deforestation. Trees naturally absorb carbon dioxide, but large-scale deforestation reduces this ability and contributes further to rising atmospheric CO2 levels. Industrial activities. Industrial processes, including manufacturing, agriculture, and waste management, release significant amounts of methane, nitrous oxide, and other pollutants into the air. The impacts of climate change are vast and varied. Increased temperatures lead to melting ice caps, rising sea levels, and more frequent extreme weather events such as hurricanes, wildfires, and floods. These shifts threaten both natural ecosystems and human infrastructure. Part 2: Types of climate risk. Understanding climate risk is essential for evaluating its impact on various sectors, markets, and investment portfolios. Climate risk is broadly categorized into two main types: physical risks and transition risks. Both types present different challenges to businesses, financial institutions, and governments. Physical risks. Physical risks are the direct impacts of climate change on infrastructure, industries, and natural systems. These can be broken down into acute and chronic risks. Acute risks. These refer to extreme weather events such as hurricanes, floods, wildfires, and heat waves. These events cause immediate, tangible damage to infrastructure, disrupt supply chains, and lead to significant economic losses. For example, a severe hurricane might damage oil refineries, leading to disruptions in fuel supply and global markets. Chronic risks. These are slower onset risks such as rising sea levels, longer droughts, and shifts in climate patterns. Chronic risks manifest over decades and often result in gradual changes to ecosystems, agriculture, and water resources. Rising sea levels could threaten coastal cities, making real estate investments in these areas more risky. Similarly, prolonged droughts may negatively affect agricultural yields, thus impacting the profitability of farming sectors. Transition risks. Transition risks are associated with the shift from a high-carbon to a low-carbon economy. These risks are related to changes in policies, technologies, and market behavior as the world moves toward sustainability. They can take several forms. Policy and regulatory risks. Governments and regulatory bodies are increasingly introducing laws and regulations to address climate change. Carbon pricing mechanisms, such as carbon taxes or cap-and-trade systems, can lead to higher operational costs for businesses, particularly those with heavy carbon footprints. Policies such as the Paris Agreement aim to limit global warming, leading to stricter emissions standards for industries. Technological risks. The transition to cleaner technologies may make certain business models and products obsolete. Companies that are slow to adopt renewable energy technologies or to develop energy-efficient products could face competitive disadvantages. Moreover, industries reliant on fossil fuels, e.g., coal, oil, may experience declining demand and asset devaluation. Market risks. As public awareness of climate change grows, there is a shift in consumer preferences towards environmentally friendly products and services. Companies that fail to adapt may face reputational damage or loss of market share. Additionally, investors may shift capital away from carbon-intensive sectors and into sustainable investments, thus affecting stock prices and company valuations. Reputational and legal risks. Companies that fail to address their environmental impact or do not disclose climate-related risks may face lawsuits or damage to their reputation. Investors and consumers are increasingly looking for companies with strong environmental, social and governance (ESG) practices, and businesses that lag behind may suffer from reduced investment or consumer trust. Part 3. The economics of climate risk. The economic impact of climate change is a major consideration for businesses, investors, and governments alike. Rising temperatures, extreme weather events, and resource scarcity will affect economic productivity, trade, infrastructure, and more. Understanding the economic aspects of climate risk is essential for forecasting potential losses and opportunities. Impact on GDP, industries, and markets. Climate change affects economies by disrupting key industries and reducing overall productivity. For example, extreme weather events such as hurricanes and droughts may significantly damage infrastructure, particularly in vulnerable regions, leading to billions of dollars in lost economic output. Similarly, disruptions in agricultural production due to changing rainfall patterns could lead to higher food prices, affecting both global markets and local economies. Energy. The energy sector is heavily impacted by both physical and transition risks. Fossil fuel industries face regulatory pressures to reduce emissions, while renewable energy companies may benefit from policy incentives. Extreme weather can also affect the production of both fossil fuels and renewable energy sources, e.g., droughts affecting hydropower production. Agriculture. Climate change poses a threat to global food production by altering rainfall patterns, increasing the frequency of droughts, and expanding the range of pests and diseases. This has significant economic implications for countries reliant on agriculture and may lead to food insecurity and rising commodity prices. Infrastructure. Rising sea levels and extreme weather can cause damage to critical infrastructure such as roads, bridges, and buildings. Investment in resilience and adaptation will become more important, as will the insurance industry, which faces an increasing number of claims due to climate-related damages. Carbon pricing and its implications. Carbon pricing is a critical tool in addressing the economic impact of climate change. It aims to internalize the external costs of carbon emissions by placing a price on greenhouse gas emissions, either through a carbon tax or a cap-and-trade system. Carbon tax, a direct tax on carbon emissions, which increases the cost of fossil fuels and incentivizes businesses to adopt cleaner technologies. While this can raise operational costs for businesses, it can also spur innovation and investment in low-carbon solutions. Cap and trade, a system where companies are allocated a certain number of carbon credits and can trade these credits in the market. Companies that reduce their emissions below their allocated limit can sell their surplus credits to other companies, incentivizing overall emissions reductions. Economic modeling of climate risk. Economists and financial analysts are developing new models to account for climate risks. These models aim to quantify the potential impacts of climate change on markets and economies by incorporating climate scenarios and future projections. Models like these are crucial for valuing long-term investments, particularly those in sectors vulnerable to climate impacts. For example, a real estate investor may use climate models to assess the long-term viability of properties in flood-prone areas. Part 4. Valuation of climate risks. Valuing assets and businesses in a climate-impacted world requires adjusting traditional financial models to incorporate long-term environmental risks. This section explores how investors and analysts can integrate climate risks into valuation frameworks, ensuring that they account for future changes in the physical environment and regulatory landscape. Theories and methods for integrating climate risk. Valuation techniques typically involve assessing the risk-adjusted return on an investment. However, incorporating climate risk requires additional adjustments. Discount rates. One common approach is to adjust the discount rate used in discounted cash flow (DCF) models. A higher discount rate may be applied to investments in sectors exposed to high climate risks, reflecting the increased uncertainty associated with these assets. The rate of return required by investors may also shift as the market increasingly values low-carbon and climate-resilient investments. Scenario analysis. Investors use climate scenarios to forecast potential outcomes based on various climate pathways, e.g., 1.5 degrees Celsius, 2 degrees Celsius, or 3 degrees Celsius warming. These scenarios help assess the potential financial impacts under different policy, regulatory, and environmental conditions. For example, a scenario with stricter emissions reductions could significantly impact the profitability of coal companies. Asset and liability valuation. Companies with significant physical assets, such as real estate or infrastructure, must account for the risks of damage from extreme weather events and long-term climate shifts. In the case of liability, companies may also need to assess the potential legal costs associated with failing to meet climate-related regulations or investor expectations. Adjusting for climate risk in asset valuation. For assets such as real estate, infrastructure, and natural resources, traditional valuation approaches may no longer be sufficient. Climate risks, whether acute, like flooding, or chronic, like long-term temperature increases, must be considered in forecasting future cash flows, rental yields, and operating costs. Investors are now factoring in the likelihood of climate events that could result in diminished asset values over time. Part 5. Risk assessment and measurement techniques. To understand and manage climate risk, companies must use robust risk assessment frameworks and measurement techniques. These tools help businesses identify vulnerabilities and quantify potential losses from climate impacts. Tools for measuring physical and transition risks. Climate stress testing. This process involves testing how climate risks could impact a business or portfolio under different scenarios. For example, a real estate company might simulate how its properties would fare under a 1-in-100-year flood event, or a manufacturing firm might assess how supply chain disruptions from extreme weather could impact production schedules. Geospatial analysis. Using satellite imagery, geographic information systems (GIS), and climate modeling, businesses can assess the physical risks posed by climate change to their infrastructure. These tools allow businesses to visualize exposure to flood zones, heat waves, sea level rise, and other climate impacts. Climate scenario analysis. Similar to stress testing, this method involves creating different climate futures to assess the potential impacts on business operations, supply chains, and financial performance. It can help identify the risks posed by changing climate patterns, such as shifting agricultural zones, resource scarcity, or rising operational costs due to environmental impacts. Part 6: Financial Products and Climate Risk. As the understanding of climate risk grows, the financial industry has adapted by developing new financial products that allow investors, businesses, and governments to manage and mitigate climate-related risks. These products range from green bonds to sustainable investment funds, and they are designed to support the transition to a low-carbon economy while managing both physical and transition risks. Climate-related financial products. Green bonds. Green bonds are debt instruments issued to raise capital specifically for projects that have positive environmental or climate benefits. These projects can include renewable energy infrastructure, energy efficiency upgrades, sustainable water management, and other initiatives designed to reduce carbon emissions or increase resilience to climate change. Green bonds have gained significant popularity due to their dual appeal. They support environmental sustainability and offer investors a fixed income stream. Risks and benefits. Green bonds offer a way to diversify an investment portfolio while promoting sustainability. However, investors should be aware of potential risks, including the risk of greenwashing, where a bond is labeled as green without adequate evidence of its environmental impact. Regulatory bodies and standard-setting organizations, such as the Climate Bonds Initiative, have created guidelines to ensure the legitimacy of green bond projects. Sustainable investment funds. Sustainable investment funds, also known as ESG, environmental, social, and governance funds, pool capital to invest in companies that meet certain environmental or social criteria. These funds exclude investments in sectors that are deemed harmful to the environment, such as fossil fuels, and instead focus on sectors that contribute to climate resilience, renewable energy, or sustainable agriculture. Growth of ESG investing. The demand for ESG funds has surged, as investors, particularly millennials, are increasingly concerned with the impact of their investments on the planet. In response, asset managers are incorporating climate-related risks and opportunities into their portfolio construction. ESG investing provides a way for investors to manage climate-related risks while aligning their values with their investment choices. Measuring impact. ESG funds often include environmental metrics, such as carbon intensity or water usage, to measure the sustainability of their investments. However, there is an ongoing debate about how to standardize the measurement and reporting of ESG performance. Inconsistent definitions and reporting standards can make it difficult for investors to fully assess the environmental impact of their investments. Climate derivatives. Climate derivatives are financial instruments used to hedge against climate-related risks. These derivatives are based on climate variables such as temperature, precipitation, or wind speed, and they allow businesses or investors to protect themselves from financial losses due to extreme weather events or changing climate conditions. Types of climate derivatives. The most common climate derivatives are weather derivatives and catastrophe bonds. Weather derivatives. These are contracts where the payout is based on weather conditions, such as the number of days with temperatures above a certain threshold or the level of rainfall. For example, a company in the agriculture sector might use weather derivatives to hedge against the risk of a drought that could negatively affect crop yields. Catastrophe bonds, CAT bonds. These are bonds issued by insurers or governments to provide financial protection against natural disasters such as hurricanes, earthquakes, or floods. If a catastrophic event occurs, the bondholders may lose some or all of their principal, and the funds are used to cover the cost of disaster recovery. Use cases for climate derivatives. Companies in weather-sensitive industries, such as agriculture, energy, and tourism, are increasingly using climate derivatives to mitigate the financial impacts of adverse weather events. Insurance companies also use these instruments to transfer some of the risk of extreme weather events to the capital markets. Carbon credits and offsets. Carbon credits and offsets are financial instruments used to allow companies to compensate for their greenhouse gas emissions. Under a carbon trading system, such as the European Union Emissions Trading System, companies are allocated a certain number of carbon allowances, which they can trade on the open market. If a company emits more carbon than its allocated allowance, it must buy credits from other companies that have reduced their emissions. Carbon markets. The development of carbon markets provides an economic incentive for companies to reduce their carbon footprint. As the world moves toward stricter emissions regulations, carbon credits and offsets will play a significant role in helping companies comply with climate targets and in fostering a global market for carbon reductions. Voluntary carbon offsets. In addition to regulated carbon markets, companies can also participate in voluntary carbon offset programs. These programs allow businesses to purchase offsets to neutralize their emissions by investing in projects that reduce or capture carbon, such as reforestation, renewable energy, or methane capture initiatives. Impact investing. Impact investing refers to investments made with the intention of generating both financial returns and positive environmental or social impact. Climate change is a key focus of impact investing, as many investors seek opportunities to drive change while achieving financial growth. Climate-focused impact funds. These funds focus on projects and companies that provide solutions to climate change, such as clean energy, sustainable agriculture, water conservation, and low-carbon technologies. Impact investors evaluate projects based on both their potential for financial return and their positive environmental impact. Challenges and opportunities. Impact investing provides opportunities for investors to support climate-related innovations, but it also requires careful consideration of financial risk and the measurable impact of the investments. There is a growing demand for better tools to track and assess the effectiveness of impact investments. The role of insurers in climate risk management. Insurance companies play a key role in helping businesses and individuals manage the financial consequences of climate-related risks. As climate risks, particularly physical risks like extreme weather events, continue to grow, insurers are facing an increasing number of claims and are adjusting their business models accordingly. Climate risk and insurance pricing. Insurers use climate models and risk assessments to set prices for premiums. As climate risks increase, insurance premiums may rise, particularly in high-risk areas, e.g., flood zones or coastal regions exposed to sea level rise. However, there may also be regions where insurance becomes unaffordable or unavailable due to the increasing likelihood of catastrophic losses. Reinsurance and climate risks. Reinsurance companies, which provide insurance to primary insurers, also face exposure to climate risks. As physical risks increase, the cost of reinsurance may rise, and companies will need to carefully assess their exposure to climate-related risks. In response, reinsurers are developing more sophisticated models to assess and price climate risk. Climate resilience insurance products. Some insurers are now offering specialized products that focus on climate resilience. These products encourage businesses to adopt adaptation strategies, such as flood defenses, wind-resistant buildings, or disaster preparedness plans, by offering lower premiums to those who invest in resilience measures. Conclusion. The financial industry is increasingly recognizing the need to address climate risk through innovative products that both manage and mitigate the effects of climate change. Green bonds, ESG funds, climate derivatives, carbon markets, and impact investing are just some of the tools that are enabling businesses and investors to navigate the challenges posed by climate risk. As the world moves toward a low-carbon economy, these financial products will become increasingly important in financing the transition to sustainability and ensuring that climate risks are adequately managed. In the next part, we will explore how companies are integrating climate risk into their corporate strategy and how they are adapting to a changing climate. Part 7. Corporate Strategy and Climate Risk. As climate change accelerates, businesses around the world are realizing the importance of integrating climate risk into their corporate strategy. Climate risk is no longer a niche issue for environmentalists. It is a central consideration for investors, regulators, and business leaders. Companies that fail to acknowledge or adapt to climate risks may find themselves at a competitive disadvantage, exposed to reputational damage, legal liabilities, and financial instability. On the other hand, companies that proactively manage and adapt to climate risk can capitalize on emerging opportunities, gain investor confidence, and build long-term resilience. This part explores how businesses are incorporating climate risk into their corporate strategies, with an emphasis on the key areas of corporate governance, strategy formulation, and climate risk disclosure. Corporate governance and climate risk. The role of corporate governance in addressing climate risk is paramount. Good governance practices ensure that companies are effectively managing risks and opportunities associated with climate change, and that they are meeting the expectations of stakeholders, including investors, regulators, and consumers. A growing number of companies are establishing dedicated roles and committees within their boards to address climate risk. Board-level committees. To address the growing importance of climate risk, many companies are establishing specialized committees at the board level. These committees are responsible for overseeing climate-related risks and opportunities, and ensuring that the company integrates these considerations into its overall business strategy. For instance, some companies have created sustainability committees or environmental, social, and governance (ESG) committees tasked with managing climate-related risks. Chief Sustainability Officers, CSOs. The role of the Chief Sustainability Officer is becoming increasingly important in leading the company's efforts to address climate risk. CSOs often work across departments, such as finance, operations, and supply chain management, to ensure that sustainability and climate resilience are integrated into every aspect of the company's operations. They also play a critical role in communicating with investors and the public about the company's climate strategy and performance. Climate risk integration into risk management frameworks. Corporate risk management frameworks are evolving to include climate risk alongside traditional financial, operational, and strategic risks. Risk managers must now consider both physical risks, such as extreme weather events and supply chain disruptions, and transition risks, such as policy changes and shifting consumer preferences, when assessing overall business risk. Many companies are using enterprise risk management frameworks to integrate climate risk assessments into their broader risk management processes. Climate risk and corporate strategy. Integrating climate risk into corporate strategy requires businesses to assess their exposure to various climate-related factors and adjust their business models accordingly. Climate risks can impact a wide range of business functions, including supply chain operations, product development, and market positioning. Corporate strategy should focus on both mitigation, reducing the company's own environmental impact, and adaptation, adjusting to the physical impacts of climate change. Mitigation strategies. Decarbonizing operations. Companies are increasingly focusing on reducing their carbon footprint by transitioning to renewable energy sources, improving energy efficiency, and adopting low-carbon technologies. A growing number of companies are setting net zero emissions targets, with a goal of reducing their carbon emissions to as close to zero as possible, balancing any remaining emissions through carbon offsets. Sustainable product innovation. Businesses are increasingly focused on creating products and services that are more environmentally friendly. This could include the development of energy-efficient products, sustainable packaging, and services that help consumers reduce their carbon footprints. Companies that fail to innovate in this space may face reputational risks and lose market share to competitors that are better positioned to meet consumer demand for sustainable goods. Adaptation strategies. Resilience in operations. Companies must invest in making their operations and infrastructure resilient to the physical impacts of climate change. This could involve building flood defenses, investing in more resilient supply chains, or adapting manufacturing processes to cope with extreme temperatures. The cost of failing to invest in resilience can be high, especially for businesses in sectors exposed to climate risks such as agriculture, real estate, and energy. Supply chain diversification. Climate change poses significant risks to global supply chains, especially in sectors that rely on raw materials or manufacturing processes vulnerable to climate-related disruptions. Companies can reduce this risk by diversifying their supply chains and sourcing from regions less prone to extreme weather events, as well as investing in local and regional supply networks that are more resilient to climate impacts. Climate-resilient business models. Developing a climate-resilient business model involves more than just risk mitigation. It's about creating long-term value that incorporates sustainability at its core. Companies can pursue sustainable growth strategies by leveraging climate risk as a driver of innovation and differentiation. For example, a company might enter the rapidly growing market for clean technologies or develop new services that help customers reduce their own environmental impact, e.g., energy efficiency consulting, waste management solutions. Green innovation. Innovation in green technologies, renewable energy solutions, and sustainable materials presents a significant opportunity for businesses to not only reduce their environmental impact, but also generate new revenue streams. Businesses that can harness the potential of the green economy will position themselves as leaders in the transition to sustainability. Engagement with stakeholders. Engaging with stakeholders, investors, employees, customers, regulators, and communities is a crucial part of corporate climate strategy. Transparent communication and collaboration with stakeholders are essential for building trust and ensuring that climate risks and opportunities are understood across the value chain. Investor engagement. Investors are increasingly focused on companies' climate-related disclosures and their efforts to manage climate risk. Firms that engage proactively with investors on these issues are more likely to attract capital, as institutional investors are now considering ESG factors in their decision-making processes. Customer demand for sustainability. Consumer preferences are shifting toward more sustainable products and services. Businesses that align their strategy with this growing demand will not only help mitigate climate risk, but also capitalize on a lucrative and expanding market. In fact, some companies are finding that sustainability is a key driver of customer loyalty and brand value. Climate risk disclosure and transparency. One of the most significant developments in corporate climate strategy has been the increased pressure for climate risk disclosure. Regulatory bodies, investors, and stakeholders are demanding greater transparency about how companies assess and manage climate risks. The Task Force on Climate-Related Financial Disclosures, TCFD. The TCFD is a key initiative aimed at encouraging companies to disclose climate-related risks and opportunities in a standardized and consistent manner. The TCFD recommends that companies disclose governance, how governance structures oversee and manage climate risks. Strategy, how climate risks and opportunities are integrated into the company's strategy. Risk management, how climate risks are identified, assessed, and managed within the company's risk management framework. Metrics and targets, the metrics used to assess climate-related risks and opportunities, and the targets set to mitigate these risks, e.g., greenhouse gas emissions reduction targets. SASB standards. The Sustainability Accounting Standards Board, SASB, provides a set of industry-specific standards to guide companies in disclosing material ESG factors. SASB standards are designed to help investors assess the financial materiality of climate risks, particularly in the context of the transition to a low-carbon economy. Legal and regulatory pressure. In many regions, regulatory frameworks are evolving to require more detailed climate disclosures. For example, the European Union has introduced regulations requiring companies to disclose information on how they manage environmental risks, including climate-related risks, in their annual reports. Similarly, in the U.S., the Securities and Exchange Commission, SEC, is considering updates to disclosure rules to ensure that companies are transparent about their climate-related risks and opportunities. Conclusion: the integration of climate risk into corporate strategy is no longer a luxury, but a necessity for businesses seeking to thrive in an increasingly unpredictable and climate-impacted world. Companies that develop strong governance frameworks, embrace sustainable and resilient business models, and adopt transparent climate risk disclosures will not only mitigate potential risks but also seize opportunities in the green economy. The companies that fail to address climate risk may face financial, reputational, and operational challenges that could significantly impact their long-term survival and success. In the next part, we will delve into the regulatory frameworks and standards that are shaping how companies and investors must address climate risk. These evolving regulations play a pivotal role in driving corporate action on climate change and ensuring that businesses meet global sustainability goals. Part 8: Regulatory Frameworks and Standards for Climate Risk. As climate change accelerates and its impacts become more apparent, regulatory bodies and international organizations are increasingly focusing on creating frameworks and standards to address climate risk. These regulatory efforts aim to encourage businesses to assess, disclose, and mitigate their exposure to both physical and transition risks. The evolving regulatory landscape is playing a significant role in pushing businesses toward a more sustainable, resilient future. This part explores the most important regulatory frameworks and standards that are shaping how companies and investors must address climate risk, including mandatory and voluntary disclosures, international agreements, and emerging regulations. Global climate agreements and their impact. International climate agreements and treaties play a critical role in shaping the regulatory environment for climate risk. These agreements set the framework for reducing global greenhouse gas emissions, which in turn influences national and corporate climate policies. The Paris Agreement. The Paris Agreement is an international treaty that aims to limit global warming to well below 2 degrees Celsius above pre-industrial levels, with a target of limiting the increase to 1.5 degrees Celsius. The agreement has been a pivotal moment in the global effort to combat climate change and has significant implications for businesses and investors. Nationally Determined Contributions, NDCs. Under the Paris Agreement, each participating country sets its own emissions reduction targets, known as Nationally Determined Contributions, NDCs. These targets influence national policies and regulations, which in turn affect businesses operating within those countries. Carbon Pricing and Emission Trading Systems, ETS. The Paris Agreement encourages the adoption of carbon pricing mechanisms, including carbon taxes and cap-and-trade systems. These tools directly impact businesses by placing a price on carbon emissions, incentivizing the adoption of low-carbon technologies and practices. Kyoto Protocol. The Kyoto Protocol, which preceded the Paris Agreement, was an international treaty that committed industrialized countries to reduce greenhouse gas emissions. While the Paris Agreement has largely superseded the Kyoto Protocol, many countries still follow its frameworks for emissions trading and carbon accounting. COP26 and Future Climate Goals. The 26th Conference of the Parties, COP26, held in Glasgow in 2021, was a key moment in advancing global climate action. During COP26, countries reaffirmed their commitment to the Paris Agreement and agreed on new actions to accelerate emissions reductions, such as net zero emissions commitments. A growing number of countries and companies have committed to achieving net zero emissions by 2050, aligning their policies with the goals of the Paris Agreement. Financial sector role. COP26 also emphasized the role of the financial sector in supporting the transition to a low-carbon economy, urging banks, investors, and insurers to align their portfolios with net zero targets. Key regulatory bodies and frameworks. As climate-related risks become more recognized, Several regulatory bodies have been working to create consistent frameworks that provide clear guidance for companies to manage climate risk. These frameworks often focus on transparency, requiring companies to disclose the financial impacts of climate change and the measures they are taking to address these risks. The Financial Stability Board, FSB, and the TCFD, one of the most influential frameworks for addressing climate risk in corporate reporting is the Task Force on Climate-Related Financial Disclosures, TCFD, established by the Financial Stability Board, FSB. The TCFD's recommendations are designed to help companies and financial institutions disclose climate-related risks in a consistent, comparable, and reliable manner. Governance. The TCFD recommends that companies disclose how climate-related risks and opportunities are governed within their organizations, including the role of the board and senior management in overseeing these issues. Strategy. Companies should disclose how climate risks are integrated into their overall strategy, including how they assess the financial impact of climate change on their business. Risk management. The TCFD emphasizes the need for companies to assess and manage climate-related risks within their existing risk management frameworks. Metrics and targets. The TCFD encourages the use of clear metrics and targets to assess and report on the company's exposure to climate-related risks. This includes disclosures related to greenhouse gas emissions, energy usage, and climate-related financial impacts. The European Union (EU) and the Sustainable Finance Disclosure Regulation (SFDR), the EU has been at the forefront of regulatory efforts to address climate change and encourage sustainable finance. The Sustainable Finance Disclosure Regulation (SFDR), which came into effect in 2021, requires financial market participants, such as asset managers and pension funds, to disclose how they integrate ESG factors, including climate risk, into their investment decisions. Disclosure requirements. The SFDR requires financial institutions to disclose the integration of sustainability risks into their investment decisions, as well as how their investment products align with the EU's environmental and social goals. Green taxonomy. In conjunction with the SFDR, the EU taxonomy provides a classification system for sustainable economic activities. The EU taxonomy helps investors identify which economic activities are aligned with the EU's climate and sustainability goals, and it establishes a clear set of criteria for determining whether an activity can be considered green. The United States and the SEC. In the United States, the Securities and Exchange Commission, SEC, has been working on incorporating climate-related disclosures into its existing regulatory framework. The SEC is expected to release new rules for mandatory climate disclosures in the near future, following pressure from investors and climate advocacy groups for greater transparency around climate risk. Disclosures on climate risks. The SEC is considering requiring companies to disclose material climate-related risks, including how they assess and manage physical and transition risks, their greenhouse gas emissions, and any potential financial impacts related to climate change. Regulatory guidance. In 2010, the SEC issued guidance on climate change disclosures, encouraging companies to address the financial risks of climate change in their regular filings. This guidance has been updated over time, and there is ongoing discussion about whether to enhance or mandate more specific disclosures on climate-related risks. Voluntary standards and frameworks. In addition to mandatory regulations, several voluntary frameworks have emerged to help companies disclose their climate risk management practices. These frameworks are widely used by businesses to report on their environmental performance and improve their climate risk resilience. The Global Reporting Initiative, GRI. The Global Reporting Initiative, GRI, provides widely recognized standards for sustainability reporting, which include detailed metrics on climate change, emissions, water usage, and environmental impact. Companies that use GRI standards are encouraged to provide transparency on their climate-related risks and actions, though participation is voluntary. The CDP, formerly Carbon Disclosure Project. The CDP is an international non-profit organization that helps companies and cities disclose their environmental impact, including their exposure to climate risk. The CDP's climate change disclosure platform allows companies to report their emissions, climate-related strategies, and the financial risks associated with climate change. Thousands of companies worldwide participate in the CDP's annual climate change disclosure. The Climate Disclosure Standards Board, CDSB. The CDSB is a global consortium of business and environmental organizations that aims to provide a clear framework for reporting climate-related risks. The CDSB's framework is aligned with the TCFD recommendations and focuses on providing financial and non-financial information on climate-related issues, such as greenhouse gas emissions and climate resilience. ISO Standards for Climate Risk. The International Organization for Standardization, ISO, has developed a range of standards for environmental management and climate risk. ISO 14001 is the most widely known standard for environmental management systems, while ISO 50001 focuses on energy management. These standards help companies improve their environmental performance and integrate climate risk management into their operations. The future of climate risk regulation. As the financial implications of climate change become clearer, regulatory frameworks will continue to evolve. Governments, regulatory bodies, and international organizations are expected to take more aggressive steps to incorporate climate risk into financial reporting and corporate strategy. This may include stronger carbon pricing mechanisms. Carbon taxes and emissions trading systems are likely to become more widespread, creating stronger financial incentives for companies to reduce their carbon footprint. Mandatory disclosure of climate risk. Increasingly, governments may require companies to disclose not only their carbon emissions, but also the financial implications of both physical and transition risks. International cooperation on standards. As climate change is a global issue, international cooperation will be crucial to creating consistent and transparent regulatory frameworks. Efforts to standardize climate-related disclosures, such as through the TCFD and the EU taxonomy, will likely continue to gain momentum. Conclusion. The regulatory landscape for climate risk is evolving rapidly, with international agreements, national regulations, and voluntary frameworks all working to ensure that businesses understand and address their exposure to climate risks. As regulations become more stringent, companies will need to adapt their business models, investment strategies, and risk management frameworks to comply with new climate-related disclosure requirements. Ultimately, the global regulatory push for transparency on climate risk will not only help manage the financial impacts of climate change, but also drive the transition to a more sustainable and resilient global economy. In the next part, we will examine climate risk in investment portfolios, exploring how investors are integrating climate considerations into asset allocation and risk management practices. Part 9: Climate Risk in Investment Portfolios. The financial world is rapidly awakening to the reality of climate change and its potential to affect investment portfolios. Climate risk, whether physical, resulting from extreme weather events and changing conditions, or transition-related, arising from the shift to a low-carbon economy, is now being recognized as a crucial factor that investors must consider when constructing and managing portfolios. Ignoring climate risks can lead to significant financial losses, while incorporating these risks presents opportunities for investors to capitalize on the transition to a sustainable, low-carbon economy. This part delves into how climate risk is integrated into investment portfolios, focusing on risk assessment, asset allocation, and emerging trends in sustainable investment. It also examines the role of investors in driving corporate behavior towards sustainability, and how they can identify and mitigate risks in their portfolios. The growing importance of climate risk in investment. Physical versus transition risk. investment portfolios face two main types of climate-related risks. Physical risks. These arise from the physical impacts of climate change, such as extreme weather events, hurricanes, floods, droughts, or long-term shifts in climate patterns, rising sea levels, temperature fluctuations. These risks can disrupt supply chains, damage infrastructure, and affect the financial performance of companies, especially those in climate-vulnerable sectors such as agriculture, real estate, and energy. Transition risks. As the world moves towards a low-carbon economy, businesses and industries face risks related to regulatory changes, market shifts, and technological advancements. Transition risks include the potential for stranded assets, e.g., fossil fuel reserves that cannot be exploited due to regulations or market changes, policy shifts, e.g., carbon pricing, emission reduction targets, and evolving consumer preferences for sustainable products and services. Both physical and transition risks need to be factored into investment decision-making. By incorporating climate risk into their strategies, investors can identify long-term threats and opportunities that might otherwise be overlooked. Impact on financial performance. Climate-related risks can affect the financial performance of companies, leading to changes in the value of their stocks or bonds. For example, a company exposed to significant physical risks, such as an oil refinery located in a flood-prone area, could see its assets devalued if a natural disaster causes significant damage. Conversely, a company that proactively embraces a low-carbon strategy and invests in renewable energy technologies may experience long-term growth due to increasing consumer demand for clean energy solutions. Integrating climate risk into investment strategy. ESG integration. Environmental, social, and governance (ESG) factors have become central to investment decision-making. Climate change is a key component of the environmental pillar, and investors are increasingly integrating climate considerations into their ESG strategies. Environmental factors. Investors assess companies' efforts to reduce carbon emissions, manage resource use, e.g., energy, water, and mitigate environmental impact. They also evaluate how well companies are positioned to adapt to and capitalize on climate-related opportunities. Governance factors. Companies that have strong governance structures in place to address climate risk, such as dedicated boards or chief sustainability officers (CSOs), are often viewed more favorably by investors. Governance structures that prioritize sustainability are seen as an indicator of long-term strategic planning and risk management. Climate risk stress testing. One way that investors are integrating climate risk into their portfolios is through stress testing. Stress tests simulate the potential impacts of different climate scenarios, e.g., extreme weather events, policy changes, on investment portfolios. This helps investors understand the resilience of their portfolios under various climate conditions and make adjustments as necessary. For example, stress testing can reveal which sectors are most vulnerable to transition risks, such as the impact of carbon pricing on fossil fuel industries or the effects of stricter emissions regulations on high-carbon companies. Climate risk mapping and scenario analysis. Climate risk mapping involves identifying the assets and companies most exposed to climate-related risks. Investors use scenario analysis to model different climate futures, such as a 2 degrees Celsius or 4 degrees Celsius increase in global temperature, to determine how these scenarios might affect their investments. These analyses help investors assess not just the risks, but also the potential opportunities that could arise in a low-carbon world, such as growth in renewable energy, energy-efficient technologies, and electric vehicles. Sustainable investing and green finance. The transition to a sustainable, low-carbon economy is creating new opportunities for investors who are looking to align their portfolios with global environmental goals. Sustainable investing seeks to support businesses and initiatives that promote environmental sustainability while still delivering financial returns. Green bonds. Green bonds are debt instruments issued to finance projects that have a positive environmental impact, such as renewable energy projects, energy efficiency upgrades, or sustainable agriculture initiatives. Green bonds are becoming increasingly popular as institutional investors seek ways to invest in climate-friendly projects. The market for green bonds has grown significantly, and many investors now consider green bonds an essential part of their sustainable investment strategies. Impact investing. Impact investing goes beyond financial returns to focus on achieving measurable environmental or social impact. For climate-conscious investors, this means targeting companies, funds, or projects that contribute directly to the fight against climate change. These investments may include renewable energy infrastructure, carbon capture and storage, CCS projects, or businesses focused on the development of sustainable products and services. Sustainable funds and ETFs. Sustainable investment funds and exchange-traded funds, ETFs, allow investors to diversify their portfolios while focusing on companies that meet specific environmental, social, and governance criteria. These funds often track indices of companies that have demonstrated leadership in sustainability and climate risk management. As investor demand for sustainable products grows, more investment vehicles focused on climate-related themes are emerging. Risk management and portfolio construction. Climate-aligned asset allocation. The traditional approach to asset allocation is evolving to include climate risk factors. In constructing a climate-aligned portfolio, investors aim to balance risk and return by incorporating sustainability into their decisions. This involves reducing exposure to high-carbon industries, e.g., fossil fuels, utilities dependent on coal, that may face regulatory and market risks. Increasing exposure to sectors that are well-positioned for the transition to a low-carbon economy, such as clean energy, green building technologies, and sustainable agriculture. Considering both physical and transition risks when determining asset allocations to ensure long-term portfolio resilience. Stranded assets. As part of transition risk, stranded assets are investments that lose their value due to changes in the economy, regulations, or technological advancements. For example, oil reserves or coal-fired power plants may become stranded assets as the world moves toward cleaner energy solutions. Investors need to identify potential stranded assets in their portfolios and make adjustments to avoid significant losses. This may involve divesting from fossil fuel companies or investing in companies with a strong commitment to transitioning to a low-carbon future. Diversification across climate scenarios. Diversification is key to managing risk, and the same principle applies when addressing climate risk. By spreading investments across different sectors, regions, and asset classes, investors can better manage the uncertainties posed by climate change. For example, a diversified portfolio may include both renewable energy stocks and companies that are transitioning to greener technologies, as well as green bonds and climate-focused funds. The role of investors in driving corporate climate action. Investors play a significant role in encouraging companies to address climate risk and adopt sustainable practices. Through their influence, investors can push companies to set and disclose science-based targets for reducing carbon emissions, align their business strategies with global sustainability goals, such as the Paris Agreement, improve transparency around climate risk exposure and risk management strategies through frameworks like the TCFD. Shareholder engagement, including voting on climate-related resolutions at annual general meetings, AGMs, can also be a powerful tool for driving corporate behavior. Many institutional investors are using their voting power to advocate for greater climate action, pushing companies to improve their environmental performance. Conclusion. The integration of climate risk into investment portfolios is no longer optional. It is essential for investors who seek to protect and grow their capital in the face of climate change. By understanding and incorporating both physical and transition risks into their decision-making, investors can build more resilient portfolios and capitalize on the opportunities presented by the transition to a low-carbon economy. Sustainable investing, through vehicles like green bonds, impact investing, and sustainable funds, allows investors to align their financial goals with their environmental values. As we continue to witness the growing importance of climate risk, the next part will explore climate risk reporting and disclosure, focusing on the tools and methodologies that investors and businesses can use to effectively communicate their climate-related efforts and performance. Part 10: Climate Risk Reporting and Disclosure. As the world increasingly confronts the urgent need to address climate change, transparency and accountability have become critical in guiding corporate and investor decision-making. Climate risk reporting and disclosure play a vital role in this process, allowing stakeholders, ranging from investors and regulators to consumers and advocacy groups, to assess how companies are managing the financial implications of climate change. Climate risk reporting involves providing clear, consistent, and comparable information about how organizations are identifying, assessing, and mitigating both physical and transition risks related to climate change. This part explores the importance of climate risk disclosure, the frameworks guiding these disclosures, the tools and metrics used, and the emerging best practices for ensuring transparency in reporting. The importance of climate risk reporting. Investor demand for transparency. In recent years, investors have increasingly demanded greater transparency regarding how companies are managing climate-related risks. As institutional investors, asset managers, and pension funds integrate environmental, social, and governance (ESG) criteria into their investment strategies, clear and standardized reporting has become a necessity. Investors need to understand how companies are exposed to climate risk and what strategies they are implementing to manage these risks in order to make informed investment decisions. Regulatory requirements and compliance. Regulatory bodies worldwide are increasingly mandating climate-related disclosures to ensure that businesses understand their climate risks and opportunities. The goal is to provide stakeholders with the necessary information to evaluate how climate change could impact the financial performance and long-term sustainability of companies. These regulations not only promote transparency, but also encourage businesses to take proactive measures to manage and mitigate climate risk. Corporate accountability and reputation. Companies are recognizing that climate risk reporting is not just about compliance, it's also about demonstrating accountability to stakeholders, including customers, employees, and shareholders. Transparent reporting builds trust and helps companies align their strategies with the growing demand for sustainability. Companies that fail to disclose or adequately manage climate risks may face reputational damage, loss of market share, or regulatory penalties. Global standardization of reporting. A consistent, global approach to climate risk reporting enables comparability across sectors and regions, which is crucial for investors who are managing global portfolios. Efforts to standardize climate disclosures have led to the development of widely adopted reporting frameworks, with the aim of improving the quality and consistency of climate-related information. Key frameworks for climate risk reporting. Several reporting frameworks and standards guide how companies should disclose climate-related risks. These frameworks are developed by international organizations, industry groups, and regulatory bodies, and help businesses report on their climate impact and strategies. The most widely recognized frameworks include Task Force on Climate-Related Financial Disclosures, TCFD. Established by the Financial Stability Board, FSB, the TCFD provides comprehensive guidelines for companies to disclose climate-related risks and opportunities in their financial filings. The TCFD's recommendations are now considered a global benchmark for climate risk reporting. The TCFD framework encourages companies to disclose governance, how climate-related risks and opportunities are governed within the organization, including the role of the board and senior management. Strategy, how the company's strategy is aligned with climate-related risks and opportunities, and how it plans to address potential climate impacts. Risk management. The processes in place for identifying, assessing, and managing climate-related risks. Metrics and targets. The metrics used to assess climate-related risks, and the targets the company has set for managing these risks, such as emissions reductions, energy usage, and sustainability goals. The Global Reporting Initiative, GRI. The Global Reporting Initiative, GRI, is another widely used framework for sustainability reporting. The GRI standards allow companies to report on a broad range of environmental, social, and governance (ESG) factors, including climate change. The GRI's environmental standards specifically focus on reporting issues like greenhouse gas emissions, energy consumption, water usage, and waste management. The Climate Disclosure Standards Board, CDSB. The CDSB is an international consortium that provides a framework for integrating climate-related disclosures into mainstream financial reporting. The CDSB's framework aligns closely with the TCFD recommendations and focuses on enabling companies to disclose the financial impacts of climate change within their existing reporting structures. The goal is to help companies integrate climate information into their financial disclosures, making it easier for investors to assess the climate risks facing a company. Sustainable Accounting Standards Board, SASB. The Sustainable Accounting Standards Board, SASB, develops industry-specific standards for reporting on ESG factors, including climate-related risks. SASB standards focus on material sustainability issues that are most likely to impact financial performance. For example, in the energy sector, SASB standards may focus on emissions reductions, while in the technology sector, the standards might emphasize energy efficiency and the carbon footprint of data centers. EU Non-Financial Reporting Directive, NFRD, and Corporate Sustainability Reporting Directive, CSRD. The European Union has introduced regulations requiring companies to disclose ESG factors, including climate risk. The Non-Financial Reporting Directive, NFRD, mandates certain large companies to disclose non-financial information, such as environmental impact, social responsibility, and governance practices. The Corporate Sustainability Reporting Directive, CSRD, which is set to replace the NFRD, will further strengthen climate risk disclosure requirements and expand the scope to include more companies, with stricter guidelines on the depth and breadth of climate-related information. Integrated Reporting Framework, IR. The International Integrated Reporting Council, IIRC, promotes the Integrated Reporting Framework, IR, which encourages businesses to disclose their financial and non-financial performance in a holistic and concise manner. IR is designed to show how an organization creates value over time, including addressing climate-related risks and opportunities as part of its long-term strategy. Climate risk metrics and indicators. To ensure meaningful and comparable climate risk disclosure, companies need to report specific metrics and indicators that quantify their exposure to climate risks and the steps they are taking to address these risks. Common metrics include greenhouse gas (GHG) emissions. One of the most important metrics for assessing a company's exposure to climate risk is its GHG emissions. Reporting on emissions broken down by scope, Scope 1, Scope 2, and Scope 3, helps investors understand the company's direct and indirect carbon footprint. Scope 1. Direct emissions from company-owned or controlled sources, e.g., emissions from manufacturing facilities. Scope 2. Indirect emissions from purchased electricity, steam, heating, and cooling. Scope 3. Indirect emissions from the value chain, including upstream and downstream activities, e.g., emissions from the production of purchased goods, transportation, or waste disposal. Carbon intensity. Carbon intensity measures the amount of carbon dioxide, CO2, emitted per unit of economic output such as revenue or production. This metric is useful for comparing companies across sectors and assessing how efficiently they are reducing their carbon footprint. Physical risk exposure. Companies should disclose their exposure to physical climate risks, including how vulnerable their assets, operations, and supply chains are to extreme weather events or long-term climate changes. This may include details about facilities in flood-prone areas or in regions susceptible to wildfires or droughts. Transition risk exposure. Reporting on transition risks involves disclosing how companies are responding to the shift toward a low-carbon economy, including their strategies to manage regulatory risks, e.g., carbon pricing, emissions caps, and technological changes, e.g., adopting renewable energy sources or energy-efficient technologies. Climate-related opportunities. Beyond risks, companies should also disclose the opportunities arising from the transition to a low-carbon economy. This includes investments in renewable energy, low-carbon products and services, and innovative technologies that can reduce environmental impact. Emerging trends in climate risk reporting. As climate change becomes a central focus for regulators, investors, and the public, several emerging trends are reshaping how companies approach climate risk reporting. Mandatory climate disclosure. Many countries and regions are moving toward mandatory climate risk disclosure. The EU's Corporate Sustainability Reporting Directive, CSRD, is a significant step forward, requiring more companies to disclose climate-related risks and align their reporting with the TCFD recommendations. Similarly, the SEC in the U.S. is considering new regulations for mandatory climate disclosures. Focus on scenario analysis. Scenario analysis is becoming a crucial tool for assessing how different climate futures, e.g., a 1.5 degrees Celsius or 4 degrees Celsius world, might affect companies. This helps companies and investors understand the potential impacts of climate change on their business models and financial performance. The TCFD has emphasized the importance of scenario analysis, and its adoption is expected to grow. Integration with financial reporting. There is a growing push to integrate climate risk disclosures directly into financial reporting, making them an integral part of a company's overall financial health and risk profile. This aligns with efforts from the CDSB and TCFD to incorporate climate risk into annual financial reports and filings. Conclusion. Climate risk reporting and disclosure are essential for promoting transparency, accountability, and informed decision-making in the face of climate change. With the growing regulatory and investor demand for standardized and comprehensive climate disclosures, companies are increasingly recognizing the importance of communicating their climate-related risks and strategies. By adopting global frameworks such as the TCFD, GRI, and CDSB, businesses can demonstrate leadership in sustainability and resilience, while investors gain the clarity they need to manage their portfolios effectively.